This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor. Welcome to the Aurellan Intergenerational Thinking podcast. My name's Chris Leva, CEO and CIO of Aurellan. Today I'm joined by two extra special guests, Fiona Foster, who's a partner at Movac, and Andrew Bascand, who is co-CEO of Harbour Asset Management. Today we're going to cover a really important topic, and that is the health of New Zealand's capital markets. And I can't think of two better guests to have on the show today. Welcome, Fee and Andrew.
Thank you.
Look, before we start getting into the podcast, I really just want to learn a bit more about who you are and what you do at your respective organisations. So, look, starting with you, Fee, tell me about your role at Movac and a bit more about what Movac does.
Yeah, sure. Thanks very much for having me. Great to be here. I'm a proud Wellingtonian, so happy to be here recording in Wellington. Movac, if I start with Movac, we're New Zealand's oldest and largest venture capital fund, so been around since the 1990s, which is a proud legacy that we're very proud of, and the largest fund in terms of funds under management. I'm focused on the growth part of our portfolio, so that's, I think we'll come to it a little bit later, but that's the area I'm focused on is investing in companies that have already got proven revenue, a proven track record. They've got customers in New Zealand and customers offshore, and they're really looking for growth capital to accelerate and supercharge their journey. So that's the area I'm focused on. Relevant to this is that we've just announced this week, actually, that we've raised our 7th growth fund to invest in this part of the market. So a almost $200 million fund now backed by institutional investors here in New Zealand, the likes of NZ Super and Government Superannuation Fund. And what my day-to-day involves is, supporting our existing portfolio of companies, so our founders, Auror, Hnry, Crimson, as they scale globally, but also with our new fund behind us, being able to back the next wave of investors. And it's a real privilege to be able to do that, and it's a pretty exciting part of the market to be working in. So that's us.
Awesome. And I'm sure we'll talk about some of those companies later on in the podcast.
Sure we will.
Now, Andrew, I should know what you do at Harbour, but tell us more about Harbour and what your day-to-day looks like there.
Well, thanks, Chris, for having us on the podcast today. Nice to see you, Fiona. I think, like you, I'm a founder of Harbour Asset Management 16, 17 years ago. Now I'm the co-CEO and CIO. Harbour today is a very diversified fund manager, investment manager in New Zealand, managing about $28 billion across institutional, retail and KiwiSaver clients. And so our view of the New Zealand market, it's great. It's got great prospects ahead of it. I think that today's conversation is highly relevant. I'm looking forward to getting into it.
Awesome. So today we're going to talk about what's quite a topical topic, being New Zealand companies. And we've really seen in New Zealand over the past few years a lot of growth in this early stage investment space. And we've probably seen, Andrew, in the New Zealand share market, after a period of rapid, very strong, world-leading returns, perhaps a time of returns that have been less favourable relative to global markets. So the purpose of today's podcast is to really do a deep dive and give people an idea on a forward-looking basis when we're looking at companies, how do we consider both the public and private markets? And we have seen this, I suppose, trend globally, right, of companies remaining private for longer. We saw the SpaceX IPO the other day.
Yep.
We used to think that it was only kind of small companies that list, and now you're talking in not even in the billions, but in the trillions. Yep. So we're seeing this move globally. Are you seeing much evidence of that in New Zealand around companies remaining private for longer?
Yeah, so I think the trends that we're seeing globally absolutely exist here in New Zealand. There are a few nuances, but if we start global, just the sheer weight of capital that's coming into private markets, there's a huge amount of money in sort of endowment funds, sovereign wealth funds, institutional investors who are looking for some sort of diversification into alternative assets or private markets from their base. That kind of sheer weight of capital is real globally, and we're certainly seeing some of that in New Zealand. I think you've already touched on this, but the place that we're falling behind, frankly, in New Zealand is with KiwiSaver and the lack of KiwiSaver funding coming into this market. So that's one difference. That being said, there is a huge amount of capital here in private markets in New Zealand already. These companies, because of that, are being funded from really early stage all the way up to Series C, Series D. These good founders and good companies have access to capital at every stage of their journey should they want it here in New Zealand. And on the flip side, there has been a real lack of liquidity at the other end. So, you're saying we're starting to see the IPO window open up overseas. There's been a dearth of that liquidity in recent years, and that's forcing companies to sometimes stay private longer than they otherwise may have wanted to. It kind of produces other dynamics in the market, though. So secondary markets are now becoming more of a viable option in New Zealand. At Movac, we've got a fund that's focused purely on secondaries now. And so what that means is companies can stay private longer, but founders, early investors, some early employees can take a little bit of money off the table from the value they've created while they can benefit in that value while enabling the company to kind of stay private longer and continue to go. So yeah, we're seeing similar evidence here in New Zealand. Whether it's this kind of one-off structural shift towards companies staying private for longer, who knows, or whether it's kind of part of the macroeconomic cycle. I think whatever happens in the IPO market over the coming years off the back of SpaceX and maybe Anthropic it's going to be interesting to watch.
Yeah, for sure. And look, Andrew, another trend we're seeing is that I suppose balanced portfolio investors have gone from having probably quite a large home country bias to a smaller one and putting more money in global shares at the expense of New Zealand shares. I mean, interesting for me, we just covered this recently in a paper looking at the tax benefits of New Zealand shares, which are really quite substantial for a New Zealand taxpayer. So I've kind of given some of my view already, but how do you view New Zealand relative to the global market right now in terms of Harbour's assets?
It's a really good question. I think you anchor yourself in the long-term expected returns of each asset class, and we still think New Zealand listed equities have probably a 7.5% to 8% gross return. Imputation credits make that reasonably attractive. We would have said only 4 or 5 years ago that global equities probably had a much higher risk premium available. The performance of global equities now means pretty much even view. I think the key point you observe, however, is we do have a much deeper liquidity globally. We have different sectors globally. New Zealand tends to be a defensive, very, very focused on an energy sector, gentailers, and 4 or 5 high growth companies. Whereas you look globally, you've got a broader spectrum, not just through tech and software, but through healthcare growth companies and broader opportunities. So our view would be we are beginning to see some of those asset allocations move from maybe a third, 2/3 in terms of the growth allocation, more higher weighting in global equities. But I would say that the key perspective I'm expecting to see is a greater allocation to private assets within that. So I think global private equity, local private equity, I think will take some of that growth allocation, Chris.
And Fee, just on kind of private markets, it feels to me that the New Zealand venture capital ecosystem has just gone from kind of 0 to 100, quite quickly. And we've got this wave of companies now, you mentioned some of them earlier, that are really getting to the stage where their next step, whatever that is, and maybe something they're considering. So, when you think broadly of the Movac VC portfolio and you think of exiting, could this lead to more listings in the New Zealand market? Where does an NZX listing kind of come up with these companies?
Yeah. It's a great question. I mean, first, you're absolutely right. We're seeing a wave, kind of a cohort of these companies coming through, which is super exciting to see. It's a slightly loaded question. Like, it's pretty tricky thinking about the NZX in this space, and kind of can talk about it from a couple of angles. I think the first question is, does it make sense for these companies to think about a listing full stop, whether that's New Zealand or globally? That's kind of the first question. And honestly, for a large number of the companies we're working with, what makes a good IPO candidate? It's often kind of predictability, the ability to have really strong underlying fundamentals, and then being able to forecast where you're going and kind of beat and raise quarter on quarter. And frankly, that's not where a lot of these companies are. These companies at the forefront of innovation, they're moving extremely quickly. Predictability isn't necessarily the priority right now. And so we have to really think carefully about, is IPO the right path? They're often founder-led, and founders have to think about whether being a publicly listed CEO is the direction that they're going in. And often we've seen, Movac and other investors in the space kind of create value for shareholders has been strategic M&A. So it's offshore investors or offshore acquirers, the likes of Apple, Microsoft, Lightspeed have come in and acquired these tech businesses from New Zealand. So that's a little bit of the landscape. Not to suggest that public markets is the wrong path, but it's, for some of our companies, not necessarily the right path. I think public markets, absolutely, broader audience, the storytelling and the reach that you can get makes sense for some businesses. We just have to first ask the question, where does it make the most sense? That being said, in some cases it totally does. So we're having live conversations with some of our portfolio companies right now, and a number of exchanges both here and around the world around what a listing could look like. It would be awesome to see more of these companies take the opportunity to kind of consider whether NZX is the right path. It's not sort of a new story to say that the market here in New Zealand is a little tough in terms of depth of investor and volume, and you kind of touched on it earlier, Andrew, around the sorts of companies that are really succeeding here in public markets in New Zealand.
I think in that regard, I quite like the idea going forward that there are hybrid models of listing of companies that are still have private founders. It's still quite possible that access to capital is still coming from private sources and public sources. A key example in New Zealand, Chris, would be Infratil. Now, Infratil has many private assets sitting in that portfolio. Think of Long Road, think of CDC, but it's listed and it's getting access to private capital, the large sovereign wealth funds, and public capital, and raising from both sources. So I think these hybrid models will be important going forward for some companies where, as you touched on, predictability of earnings is more obvious. If you're still innovating at such a fast pace in deep tech, probably too early to list, right?
Yeah, and that's exactly right, and that's sort of that's what we're kind of constantly tossing up. So absolutely, I mean, to your original question, absolutely kind of have these live conversations with the exchanges, and some of our companies are probably pretty good candidates for that in the coming years. We just constantly have to weigh that up with what the other options are and how we're creating, strategic value for all shareholders.
Fi, just on that, with New Zealand specifically, because a lot of these early stage companies are looking at kind of global markets, does that kind of tie into, perhaps not just looking in New Zealand and kind of further afield, trying to get a listing near their target market? Is that important to founders?
Yeah, I think it's important to remember. People forget that some of these companies are these are global companies, right? A lot of them, the vast majority of their revenue is actually offshore. And so you have to think about, where are our customers? Where is the investor set that understands the problem that we're solving in the market that we're going after? And you have to make sure you're marrying those things up. And if, access to a huge additional new pool of capital is what they're after, then they do have to seriously consider whether a global exchange is the right place to be looking.
Andrew, let's say you were stuck in a lift and next to you was a founder of a New Zealand company looking at options. As someone who's, I suppose, worked in both global and New Zealand markets, what would your pitch be to them to listing their company?
Well, listing full stop is, do you need access to public markets? Secondly, is your company doing significant business, say, in the US or Europe? So therefore, with fees viewpoint, maybe a listing there might be as important for brand and access to capital. But there's a home country bias. If you're a founder here, you're proud to be here, and more dual listings may be possible. The New Zealand Stock Exchange is thinking about changing its one class of share for everyone. So there's a consultation document right out there now, dual class share listings, where founders might have a greater voting sense with respect to their shares. And I think that's an interesting consultation. So Singapore, Hong Kong, obviously the US have this in spades. Whether that really alters the scene for my pitch to a founder, Chris, it might for some. It might for some. And in that regard, my view would be, I think hybrid models of still access to private capital and access to public markets are likely to spill onto the page through potentially holding company funds. I'll give you an example. I can see the day where maybe Movac lists, weird, but maybe that's a bit tough. But seriously, if you go overseas, you've got KKR, you've got Apollo, all these big private equity houses are listed and they're almost vehicles in themselves. So I think there's going to be new models. Chris, we could spill onto the page also discussions of how tokenisation is going to break through, I think, access to private assets.
I did not think of tokenisation, but my co-founder's very, very big on that. Fee, tell me a bit about the companies in the space that you play in, because I suppose with venture capital, at its very kind of core, if you're not familiar with it, you might, I think a lot of people might think of it more as kind of seed as opposed to venture capital, through to Series A, Series B, Series C. You're talking about some pretty mature companies. So can you just give us a feel for the range of the companies that Movac invests in, perhaps from the smaller end of town to perhaps some of the bigger portfolio companies?
Yeah, sure. I think it's a good call out, and what I would say is every venture capital fund kind of has their own niche and their own focus, so it differs depending on who you're talking to. For us, we invest what we say is full life cycle. So from early stage, like you mentioned, these are companies that are often pre-revenue. They're really focused on research and product development. They're typically starting to articulate a commercialization path, but they haven't yet got a real track record of repeatable revenue. These are the likes of, we've got Illumio here in Wellington, so that's a company that's developing a portable MRI machine. Maruku, not too far up the road in Palmerston North, they're an alternative protein company. The likes of Dawn Aerospace is kind of broken out of this stage now, but when we first invested a number of years ago down in Christchurch, they were sort of that true scalable revenue business model. So that's what we think about at the early stage. Often we're writing $500,000 or $1 million checks at that point. And then you've got all the way up to what we'd think of as more growth equity. So growth equity is, these are businesses that are doing tens of millions of dollars in annual revenue, and in some cases hundreds of millions in the Movac portfolio. They've got customers globally. They're raising capital to really accelerate a trajectory that they're already on, and they're going after new markets, new products, and new customer sets with that capital. This is the likes of Auror, Crimson, Hnry, who, some of the names that people probably have heard of before. And at that point, from Movac's perspective, we're writing $20, $30 million plus checks at that stage. And I think you're right. People often forget that venture capital also captures that part of the market. So that's pre-seed and seed all the way up to Series C and Series D. The kind of common thread is that they're all tech businesses. They're all businesses that have real potential for, outsized scaling, and that taking on additional capital will help to accelerate that trajectory. And they're super ambitious founders that are going after a global problem. That's kind of the thread that runs through regardless of what stage we're investing in.
Yeah, wow. No, thank you for that. We're just going to contrast that now with Andrew, within, I suppose, focusing on New Zealand companies. One, tell me about some of the companies, but two, I'm really interested in your perspective on cash flows, because something that's happening globally at the moment is because we've got this CapEx boom around AI, we're seeing the free cash flow of US businesses just fall quite substantially. Whereas when I look at New Zealand, you talked about more stable companies earlier. How does the cash flow profile of the New Zealand market look relative to kind of global at the moment?
Yeah, I think there's been a long-term view that New Zealand investors have been attracted to cash flow. So we've had cash flow-rich defensive companies in the market. However, there's this pocket of companies that have been focused on growing their global market. They're pushing into total addressable markets that are really large. A classic example, of course, for the last 20 years has been Fisher Paykel Healthcare, spun out of an appliance manufacturer, right? That was deep tech. It was deep tech, right?
Yeah, absolutely.
Spun out. Value day one was less than 100 million. Now look at that company, New Zealand's largest company. And they earned the right, Chris, not to spit out cash flow, but to actually reinvest. And I think that's a classic example of a New Zealand company backed by shareholders because they win in public markets by over-delivering. Xero could have been another example, didn't pay a dividend, carried on, got to number 2 position in markets. Obviously, that's really important. I think when we look at the basis for earning that right not to return dividends, it's having that story to say we actually are only just beginning on addressing the problems in the world in our total addressable market. I think New Zealand is prepared to back those companies, but you see in the NASDAQ these companies are much more prevalent and much more significant. And I think so from that perspective, we've still got to go on a journey for New Zealand investors in a public sense, Chris, to back these companies who are reinvesting their cash flows.
It's that constant tension, right, between growth and profitability, and growth at all costs, and how, what are people valuing in the market at what point in time?
Yeah, it's interesting. I remember hearing, Andrew might have told this to me, but, when a company pays a dividend, it's a way of them telling you that, they feel that the money is better with you relative to being reinvested in their business. And yeah, I mean,
interesting perspective. Yeah.
Yeah. Now, Fee, look, rewind 10 years. We've talked about the development in New Zealand VC relative to back then, and 10 years ago, I suppose. Rewind 10 years, Movac's standing alone with not many peers is probably one of the biggest kind of things. But what is the difference today versus then? Perhaps in terms of companies or other market observations.
Yeah, sure. It's certainly a fair observation. I mean, 10 years ago, there were nowhere near as many venture capital funds, but acting here in New Zealand. You're right, kind of Movac was somewhat standing on our own, didn't have a real cohort of peers. In one sense, I guess that's a nice position to be in, not having a huge amount of competition when you're looking into these companies. But it was pretty hard for founders, right? They had a lack of funding options. They, if they did get funding from Movac, we were one partner and we didn't have super deep pockets. And that meant that, the capital availability to actually grow these businesses was relatively limited. Maybe to put it into perspective, at that time, we had just raised Fund 4, which was our first fund that went just over $100 million. And the fund prior to that was a $40 million fund. So that's kind of where we were operating. If you come to today, we've, in the last 10 years, raised about $750 million in capital since then. Most recent one being the fund I mentioned earlier. So we've raised another $185 million to invest in the next stage of growth companies. And we're certainly not standing on our own anymore. We've got plenty of venture investor peers, both New Zealand funds and global funds who are looking genuinely to the opportunities that exist within New Zealand tech companies. And that makes a huge difference for founders. So founders now, have multiple capital partners that they can speak to. There's huge credibility and capability in terms of the investment partners that you can choose. And we, more often than not, I think people don't realise, but more often than not, we're co-investing alongside each other. So we co-invest with our other venture capital fund peers and really like being around the table with one another. So in terms of how it's changed, I think, for us as a fund, it's a markedly different environment to be working in, but it's a hugely different opportunity that presents for founders in New Zealand. And then in terms of the market in general, I think a lot of people don't realise this, but tech is actually one of New Zealand's fastest growing export sectors. And it's now, I believe, second only or third only behind dairy and tourism in terms of an export earner for the New Zealand economy. And that presents huge opportunity, right? We talk a lot about productivity challenges in New Zealand. And if we could turn a little bit more to telling the story of what tech can do to unlock productivity, innovate, and bring New Zealand forward into the next century, I think there's a huge amount we can do. So, that change over the last 10 years, while it's great for founders and it's great for the venture capital funds amongst us, it's actually a huge benefit, I think, to the New Zealand economy as a whole. And I think, it's super exciting. We just need to make sure we're telling that story to all of New Zealand, in my mind.
And Fee, you've talked about there are more funds. You guys are raising bigger funds. Does that mean there's more ideas than there were 10 years ago? And what kind of drives that aspect? I've heard of I'll get the effect wrong, but there's, we've had some successful companies and, people tend to spin out of them. I think the founder of Halter is a good example of that. Is that what drives it? Is it a momentum thing or is it?
Yeah, I think talent and experience is a huge part of it, right? You've mentioned that one example of Halter coming out of Rocket Lab, but we're seeing that a lot. So, the likes of the cohort that are coming through today have often had that experience and that scar tissue build up in places like TradeMe, Rocket Lab, Xero, and that makes a huge difference. Like these aren't overnight successes, these businesses. There is a huge hard graft that goes on behind the scenes, and to the extent that talent can have that experience, have that scar tissue and have those learnings and take them into the next wave of companies, that's a huge upside for everyone. And also just, your point maybe around, do we have more ideas? I don't know if it's more ideas, but maybe we're showing people with ideas what's possible from New Zealand. I think a long time ago, Sir Peter Beck was very much, told, you're never going to build a rocket company out of New Zealand. And he's shown that you absolutely can. And so what we're showing people what can happen with true ambition and kind of paving the way. And I think that ambition just leads to more people saying, well, yes, I've got the talent that I can hire here in New Zealand. I've got access to capital here in New Zealand and I've been shown what's possible from New Zealand. So why don't I go for it?
Yeah, and now we might have two big rocket companies with Dawn doing really well also. Andrew, same lens on the New Zealand market. What's changed most in the last decade for you?
I think in that regard, an appreciation that when you build these diversified portfolios, Chris, you don't just have to be a passive investor in the public markets. Being active in public markets, I think, is really important. Taking part in discussions of whether a company should be private or public, encouraging founders to think about those issues, and then exploring the opportunity in diversified portfolios to work out how best to participate in private markets and at what point you want to participate, how much venture, how much growth, and whether you're doing that in New Zealand or whether you're also doing it overseas. And I think all that whole spectrum, that's a continuous spectrum of thinking about participating in capital markets. In the old days, Chris, it was about, you've got some bonds, you've got a bit of cash, you've got some New Zealand equities, probably too many. And now I think we're truly understanding, as global pension funds have for a decade or more, how to build these really robust, diversified, active portfolios. So I think that's the exciting thing. We don't have to leave on the table opportunities for investors to participate. And by that I mean all investors, retail as well, through the KiwiSaver.
Yeah, absolutely.
Fee, let's look forward 10 years now. This is the exciting thing, and I'm, being a VC, I'm expecting a very exciting answer to this one. Take us forward 10 years and let's think, could we see out of New Zealand, say, we've had SpaceX at almost $2 trillion. Could we see a $100 billion company in New Zealand? And are there any you look at the portfolio now and go, that could be a $100 billion company one day?
Yeah, another great question. You put me on the spot a little bit, but I would love to see a $100 billion company come out of New Zealand. Absolutely, that comes back to that ambition point, right? It would be a huge portion of New Zealand's GDP if we had a $100 billion company coming out of the country. So
it doesn't have to earn all its revenue here.
This is true, it doesn't. But it would be amazing to see. I'd love to. And I think it's going to be more of the same, right? The recycling of capital, the recycling of talent, and seeing that ambition is going to be what drives us there. Fast forward 10 years on it, we haven't really touched on it yet, which is amazing that we haven't, but AI is just fundamentally changing things faster than I think any of us could really imagine, both in terms of how we operate, but the companies that we're investing in. And if anyone can tell us exactly how things are going to look in 10 years, I'd love to. I'd love to know. But I think what we're going to see is we're going to see more of it out in New Zealand. We're going to see it happening faster. And I also think none of us can predict quite the direction it's going to go in. But I'm excited to be here for the journey, and whether there's a Movac portfolio company in there that gets to $100 billion, would love to see it.
So would I. That would be fantastic. I think Andrew would too. Andrew, New Zealand, NZX, I think it gets a bit of a bad rap the last few years, because the reality is, you've touched on Fisher Paykel Healthcare already. That's a massive success story in terms of the wealth that's created for people who have invested in it for, a number of kind of decades now. We've also had, Xero, A2 Milk. I know you were, early participants in both those stories. So I suppose to put it on you now, when you look in the portfolio today and you look at the New Zealand market, do we have another sleeper like that? Sleeping in the portfolio, which in the next 10 years could really grow to a big scale?
I think the answer to that, the highest probability, it's one of those existing companies that carries on growing and compounding at 15 to 20%, and they'll get there. I've mentioned Infratil already, but they are growing their exposure to renewable energy in the US at 2 gigawatt a year, and have an ambition for producing more electricity in the US than basically we're adding in New Zealand. It's just astonishing what they're doing. So if they're successful, they'll create 2 or 3 Meridian Energies in that portfolio. Now, there's an example of that public to private hybrid model. Fisher Paykel Healthcare still not really addressing the full addressable market globally, so that's a possibility. And then we think about New Zealand founder-led companies. You've already touched on Dawn Aerospace, but just imagine, I think, if they carry on at their trajectory, that's just this phenomenal Kiwi story. And I think we already have a $100 billion company with a New Zealand founder, but we just don't know it yet. And you know which company I'm talking about, Chris? Wave. I think it's already there, and we just don't know it yet. So I think there are the New Zealand ingenuity. It started a long time ago, and I think now we've worked out how to keep it Kiwi.
And also, we've had to be incredibly capital efficient, these New Zealand founders, in the past because of lack of access to capital. And so it's going to be pretty amazing to see what happens when we can put more fuel on the fire of this Kiwi ingenuity.
Yeah, it is interesting, that contrast, isn't it? Because I remember, actually, it was Andrew and I went to the US a few years ago, and we were talking to one of the global PMs over there, and that was in 2023. So in 2022, you had rates go up. You saw a massive kind of sell-off in tech at the time. And I think they had a little bit of a come-to-Jesus moment at that time, in the sense that there was a lot of largesse just through to they just had so much money. You had, I think, one of the large hyperscalers at the time was building a massive campus, and they ended up cancelling that. And I remember, I think it was Salesforce, one of the companies, which had a kind of some activist investors to really kind of cut down costs. New Zealand couldn't be further from largesse in terms of...
And it's not always a good thing, right? Capital for the sake of capital, and, spending it in crazy places is a scary thought. But I think there's going to be an interesting combination in New Zealand if we can keep that Kiwi ingenuity and our roots of being very capital efficient, but then apply capital in the right places at the right time. It's going to be exciting to see. Yeah.
And Andrew, look, accessibility, that's one thing that you look at the share markets, and they have never been more accessible, right, to everyone. And that's so good. And so do you think, when you look at portfolios, is that a really good argument for continuing to have a thriving listed market, is the fact that we can get Kiwis from all walks of life getting exposure through it? And I suppose as a follow-up to that, you've talked about hybrid approaches. You run domestic funds, primarily listed. Is there potential for more of a hybrid approach so, people can get access easier, perhaps through their New Zealand shares fund?
Yeah, I think there's 3 or 4 angles here, and I think they'll all be explored, and I think maybe they all win. The first one is you can, through an existing shares fund, you can open up a window for private assets to be a portion of that fund. Mm-hmm. We've done that, 5% to start with. That allows us to invest in Movac in that New Zealand shares fund. So we get that highly diversified exposure to skilled investment managers picking VC and going through that. So I quite like that. So if you invest in those diversified New Zealand funds, you're getting an exposure directly. Secondly, in KiwiSaver, we're moving from 1-2% allocations to private assets. I think that's going to be 4 or 5 within 3 or 4 years as vintage years are laid down. In Aussie, they're at 10, so I think that's how retail gets exposed, Chris, is through KiwiSaver. But I also think we will explore, as global markets have, how listed vehicles can provide greater access through diversified approaches. The problem for retail investors is they think they want liquidity, and liquidity can be provided through listed markets. So I think they could be diversified vehicles. Finally, I mentioned tokenization. It is coming. Already in the US, in NASDAQ, NYSE, we're seeing an increasing use of tokenization to provide more public access to private assets. I think the law needs to change a little bit in New Zealand to get there. But by 2030, I think this is going to be a conversation we will be steering in a different direction.
Now, Fee, I'm not going to be too hard on you on access to private markets because you've already talked about, building the depth of the market by starting to have a fund that focuses on secondaries, which is certainly going to help. But, what else would you want to see developed within private markets to give people better access?
I mean, I think one of the things we talk about a lot in the venture industry and private markets in general is KiwiSaver is just a huge untapped potential for venture funds and for founders in New Zealand. The challenge, if I go back a step before it, the challenge I see is, you touched on it, but often retail investors or kind of broad market investors want to see liquidity. Yeah. They don't want to, they're not quite sure of these super long time horizons, and venture investing is high risk, high potential return, but it is a high risk asset class. And it's not, if I'm perfectly honest, it's not yet a super proven asset class in New Zealand. So Movac, we've been fortunate to have the legacy we have, and we've been around a while, and we've got a track record of kind of distributions to our investors over multiple years from multiple funds, and others are for sure coming along, but it's not yet a broadly proven asset class. And I do think we kind of as an industry need to get ourselves there in the next couple of years to really earn the right to open ourselves up more broadly. It does, though, add diversity. So it gives if we can get retail investors access to this asset class, I think there's huge upside potential. KiwiSaver is the obvious lever I see. I mean, I like that you've got a few other ideas as well, so hopefully they'll start to come to the bear. I think KiwiSaver is the obvious one. In Australia, I don't know if you saw these stories, but when Canva kind of became multi-billion-dollar company, the number of Australians that experienced the benefit of that just through their Australian superannuation funds was incredible, and it would be great to see that happening here in New Zealand too. We just need to get the guardrails right and need to make sure we've got the right kind of levers in place to ensure people aren't getting exposed to a level of risk that they're not comfortable with. And my biggest fear is that we get it wrong and we put people off an asset class entirely for a generation. So I'd love to see more of it. I just want to make sure we get it right.
Yeah, I think that's important because we did have a go at VC kind of late 90s, early 2000s, where we didn't quite get our timing right, and that did kind of put the industry back. And it finally feels like it has got to a better level. Last question, because we are running out of time. But election year, 2026, I love the theatre of an election year, but I want to try and get some positive ideas out of both of you, both senior people in different areas of New Zealand's capital markets. So just one idea each. One idea, Andrew, because you've always got more than one idea. What do you think that an incoming government can do to really supercharge New Zealand's capital markets? Because I don't think it's a coincidence that you get a market like the US, deepest capital markets in the world, and you get great economic prosperity as a result. So a functioning capital markets is so important in New Zealand, what's one thing an incoming government could do to make that happen?
I think we're already on the story, and that's deepening our savings culture through KiwiSaver and deepening it really early on in life, creating an education about how investments and savings are twinned, and creating a curiosity and an enthusiasm in the next generations that are coming through, because whatever we do now will be decade-long in its development, and that's the same for VC. So there's no one overnight fix, but I think this understanding of the importance of developing a savings and investment culture, this idea for KiwiSaver at birth is a great idea, and then you add to that, obviously, lifting contribution rates and compulsion.
Yep.
Perfect.
Nice.
Cool.
I mean, I think I would just add on to that. I think it all makes a huge amount of sense. Ensuring we've got the settings right for what, once we've got everyone into KiwiSaver and we've got the right levels of investment and people coming in from birth, making sure that the settings are right so that they can access a broad range of markets, and that we're not putting in place regulations or reporting requirements that mean certain asset classes are just not going to be a focus. So at the moment, maybe one example is KiwiSaver is extremely focused on fees, and fees is absolutely the only part of the question. And I think we need to broaden the conversation if we're going to broaden the asset class base that we want our KiwiSaver investors exposed to.
Yeah, I think it's a good point. I do think that is moving. I feel like we got to a point where it really was fees. But I have been encouraged over the kind of past couple of years, really, where you are seeing, and maybe it's because the pool's bigger, right? And people can make these allocations to kind of VC. But I kind of take that as well. Thanks, Fiona. Thank you, Andrew. It's been great having you both on the podcast.
Thank you for having us. It's been great.
It's been super. Thanks, Fee. Thanks, Chris.
Well, that's all we have time for today. Thanks so much for tuning in to the Intergenerational Thinking podcast. This is our 9th podcast, and we do have a library of 8 other episodes available on YouTube or your favourite streaming platform. If you'd like to hear more from Aurellan, please look us up at aurellan.com or subscribe to us on LinkedIn. Thanks very much. Thanks for listening to the Aurellan podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.